Welcome to Think Tank Exchange. I'm thrilled to have you today. Listen, everybody talks about value and there's some subjectivity, but I'm really happy to have you here because, well, you guys actually have a process behind it. And I think process is so incredibly important. And we've been, I don't know if you realize this, or maybe you do. When we met, you guys were just like a $40 million fund, and now you're a fund family with huge success. And I'm proud to have maybe played a small role in that, and definitely learned a lot during so many of our think tank calls with financial advisors. And I think a lot of them have been fortunate to have bought into your strategy. And I'm speaking about the flagship strategy, of course, the large
Right.
cap strategy. And so good for them. Kudos. We've done our job in the think tank. Maybe tell everybody a little bit about your background on this famous day, June 29th, 2023, and how you came to launch an ETF.
Sure. Well, thanks, Dan, and thanks for having us. And yeah, we've had a great relationship with the tank. You guys have introduced us to some really wonderful clients. I mean, one thing that we didn't know coming into this, having mostly an institutional background, is we didn't know the RIA community, and I have to say we really enjoyed it. I mean that in the most sincere way. The institutional community is a wonderful one as well, but it comes with sort of incremental amount of handholding and baggage and restraint. And the RIA community reminds me of the investment community 20 years ago, the institutional community 20 years ago, when I first started doing client-facing meetings. As a group of people that are independent and willing to think on their own, and the receptivity that we've enjoyed is really been phenomenal. And you guys get some credit for sure for introducing us to a lot of really, like I said, wonderful clients. And I don't mean that in a gratuitous way. It really has been a great fun time. So yeah, so starting as an ETF entrepreneur, I guess you might be the owner of that one, because I don't think anybody's accused me of that, yet. I would say we're a money manager first, Dan. And the ETF part of this was a no-brainer from our vantage point, in that we just think it's a superior vehicle to what's available in the marketplace in terms of it versus a mutual fund. We also have an SMA capability, but the vast majority of our assets are in our family of ETFs. So that's just true. And I think part of what you were asking me was to kind of back up here and give you a bit of background. And I won't go into the long story, because I've been at this for a fairly long time, back to the mid 80s, all of it until we started Distillate in the institutional side. I was an analyst. I was a director of research. Ultimately, I was running the value equity business that was part of UBS Global Asset Management in Chicago. I left that firm in 2012 after being there almost 28 years. I moved to another value-driven fundamental equity shop in Chicago to become the chief investment officer. That firm was called Institutional Capital. And that's where I met the other two co-founders of Distillate Capital. And so the three of us that are behind this have been working together for about 10 years. And actually, the work that's underneath Distillate began pretty quickly after I moved over there. And we can circle back and get into that story. We formed Distillate in 2017 with a couple of important thoughts in mind. One was simply that, the value style was being maligned, and in fact, the value benchmarks had failed. A lot of value managers had failed. But what we had, I hate the word discovered, but what we maybe discovered was that, value is a strategy. If valuation is measured accurately, and that's no small feat in today's economy, that if you measure valuation correctly, that it never really stopped working. That the issues that we have in front of us are around the measurement of value rather than the thought that, what you pay for something just matters less than it used to. So that was one element of why we started the business. We thought that there was an opportunity to do it differently, and we thought we had something that was not being offered elsewhere in the marketplace. So we're 5 years into this, a little more than that if you count when we actually funded the product internally. The ETF is coming up on a 5-year track record, but we've been ahead of the S&P every year in the flagship portfolio since we launched. And just by virtue of consistently performing better than the benchmarks, you end up being in this peer ranking position that's really pretty. We're at the top of the heap, and so I think the idea that we are doing something unique is kind of being proven out by the numbers. So I'll stop and see where you want to go here.
Well, no, I mean, I do want you to talk a little bit about your partners, because it's not just you. I mean, you're research driven, and talk a little bit about Jay and Matt too.
Yeah. So all three of us have the commonality of having been analysts at various points in time. Matt Swanson was institutional capital's pharmaceutical analyst for a very long time. He ultimately was a portfolio manager there while I was chief investment officer. And Jay Beidler, our third partner, was an analyst covering basic materials. He also worked on energy. He was actually Matt's associate analyst when he first came into the business, but he was also doing the firm's quantitative and macro work. So we are by training fundamentally driven, value-oriented people, and that is our heritage. Collectively between the three of us, we have 7 decades or more of experience. So we've been at this a fairly long time when you think about it that way.
Yeah, to the point that I was trying to make, when I'm looking at value on a traditional basis, what I tend to think about is Graham Dodd, and well, that's just wrong, right? In this world today, right? So I think the proper way to look at it is pursuant to your views, and the outcome of it. What I find interesting is you're offering up so much active share, right, in your flagship product. Talk to us a little bit about your process, because when I look at the ETF think tank tool, I see, wait, there really isn't anything out there that is similar to you guys, and yet you're just a value strategy. And I say that with sarcasm, by the way, because you
Yeah,
are
no,
just that.
I hear you, Dan. So I would say a couple things, and we can get into our process, and I'll try not to go on and on and on here. But I think your question does get to the heart of the issue and why we think about things differently. I sent a couple of slides, and if you don't mind, Dan, there was that first slide, if you can go back one, really tells an interesting story. Value, let me just step back again. Value investing as a style came about because of Ben Graham and Warren Buffett and a whole group of other people that followed that strategy. But Ben Graham really laid it out in the Intelligent Investor, a long time ago now. But it was also popular because it's intuitive, right? I mean, if you can buy a car or a house and you can pay less, it only makes sense. If you can buy a stock for less, it should inherently protect you on the downside because it's got less room to fall, but it should also give you more upside potential. When you look at this slide, it was also extraordinarily easy. The top of this slide shows the relative performance of simply buying the lowest price to book stocks in the marketplace starting in 1960 through 1990. And if you had bought the cheapest price to book stocks and shorted against it the most expensive price to book stocks over the course of that 30-year period, your performance would have been 8x better than the market. This is a relative to the market chart. So it wasn't that value was invented in order to provide an offset to growth in some style box setting. Value became popular because it beat the overall marketplace. I mean, it was sort of a very simple exercise that was everyone's ticket if you had the patience and the perseverance to kind of provide a return profile that looked like Warren Buffett's for a very long period of time. But something changed, right? Something changed because if you go through the exact same exercise at the bottom of this slide, starting in 1990, not only did it not consistently add value, but at this point, you're actually behind the curve. You've underperformed the market by doing exactly what worked brilliantly for 30 years. And I think, one of the things that you're taught early on as a value investor is that you never want to change your stripes or try to be something different midstream. And there's a reticence to be willing to go back and take a look at what you're doing with the presumption that mean reversion will always come about and you just have to wait long enough for it to happen. But in this case, we think there's a very logical reason why that bottom chart broke down. And if you go to the next slide, and I promise I won't try to make this a one slide to the next kind of conversation. But what price to book ratios ignore in the context of measuring value correctly is this terrific, enormous change that occurred in our economy over the course of the last 30, 40 years. We go back to 1960 at the top of this chart, and just to highlight the point that if you go back that far, when the accounting rules were largely being written, we had a fairly homogeneous economy in the context of doing physical things. We were stringing telephone wire, building cars, extracting oil from the ground, building a fleet of retail stores. Those were all, things that you could see and feel and touch. And when people were creating assets in that environment, they were very often, almost always, investing capital. That capital went on a balance sheet and it was slowly expensed over time. And by virtue of doing that, the balance sheets of a business probably were a reasonable proxy for the ultimate value or worth of that business. When you fast forward, and I'll skip the middle chart just to keep us, sort of moving along here, but when you look at where we are in 2020, we've morphed now to an economy that's driven, rather than by physical assets, we're driven by intellectual activities. So the development of software, branding, pharmaceuticals, all of which are processes that generate assets that, just like their counterparts, 50 or 60 years ago, build a business that ultimately generates revenues that then, creates earnings for shareholders and cash flows for shareholders. But the driver went from being capital expenditures to research and development. And the reason that that's really important is that the accounting rules were written at a time when research and development were pennies on the dollar to the amount spent in capital expenditures. And now when you look at it, within public companies, research and development is 2 to 3x what capital spending is. And when you think about, Apple creating an asset, it's very light in the context of the capital that it's spending on facilities, but where it's spending all its money is on that research and development. But that research and development, rather than being put on a balance sheet, is expensed as it's incurred. And where that leaves you is with a set of accounting statements that generate earnings and book values and ROEs and other measures that all of us were taught to use when we think about valuation and quality. that create an apples to oranges comparison. No longer can you compare Apple to AT&T on the basis of the earnings that they generate or the book value that they have on their balance sheets. You're simply, comparing two different accounting treatments for creation of assets, and that's created this disparity in the context of the use of price to book ratios. So our conjecture that price to book ratios are not effective. It's not really a subjective argument. It's just math. It's just the way the numbers fall out. And I promise I won't spend a lot of time talking about accounting, but just accounting in general has become an extraordinarily complicated exercise. And as a result of that, we think that the use of those legacy metrics, price to earnings, price to book, ROE, are just have left us in an extraordinarily difficult place in the context of accurately identifying the opportunities that are available to investors in the marketplace.
You say that like it's obvious, but there's something like $400 billion in ETF money that's associated with value, and I think it's like 80 or 90 different ways to play it, and yet so many ETFs are not doing what you're doing, right? Let's call a spade here, right? And maybe underperforming, maybe not always, don't get me wrong, but for the most part your performance has been really, really spot on, right? And I congratulate you for that.
Well, thanks. I mean, I think that is the heart of the issue, though, Dan, is that we're willing to break from the legacy of using the metrics, but the indices are largely still either solely driven by price to book ratios in terms of selecting the constituents, or there is a role that goes to or a weight that goes to price to book ratios that therefore ends up with companies that, by virtue of their accounting, still have meaningful accounting book values, being sort of chronically overrepresented in the value benchmarks. And then to the extent that you launch, typically somebody's going to launch a new value fund, they're not going to want to stray typically too far from those benchmarks, because at times when those benchmarks do well, and we can talk about the drivers, but they're not going to want to fall far short. And starting with a clean sheet of paper back to our beginning in 2017 was an extraordinarily powerful exercise, to the extent that we didn't have to necessarily adhere to an existing book of business or work with the constraints that a lot of our competitors have. And so we're willing to not work with those typical metrics. And as a result, we do end up with this very high active share that makes us look a lot different than the benchmarks and a lot different than most of the other value ETFs that are out there and available.
Interesting. So let's walk through some of the things that make you work so well. You're active, you're not passive. Why did you make that decision?
Yeah. So again, I'd back up a little bit, Dan, and I'd say a couple things. The idea of passive investing is that, part of the idea, at least, is that you take a risk off the table, right? You take a risk that you're going to underperform the benchmark, and you don't have to explain that to anybody along the way. But that doesn't mean that the decision related to picking a benchmark is necessarily optimal, or that the construction of the benchmark is optimal. The most obvious example of that is capital weighting schemes, which were an innovation in the 1920s. So like 100 years ago, we came up with cap weighting, which, before that was the world was dominated by the Dow Jones Industrial Average, which is a price weighted benchmark, which, doesn't make a whole lot of sense. But cap weighting just inherently is suboptimal for long-term investors, because you sort of by definition are buying more of what's expensive, and you're not owning enough of what is inexpensive. And when you look at a cap weighted benchmark versus the same list of names that are equal weighted, over a long period of time, the equal weighted benchmark outperforms. So, there's sort of an embedded amount of sort of conventional wisdom that I would argue is not necessarily optimal for investors. And then, the construction of the benchmarks themselves is also really critical to think about. We've already talked about the use of price to book ratios in the context of picking out what goes into the value benchmarks. We just don't think it any longer truly represents what the name implies. That, rather than getting, a group of stocks that are truly trading at the least expensive levels versus their ultimate worth, what you're getting is a group of businesses that happen to have accounting book values, and therefore they tend to look less expensive on a price to book basis in sort of a chronic way. And then you could think about sort of the makeup of the S&P right now as another issue in the context of being passive, which is, if you look at the S&P, and I think we've got one more chart in there, Dan, that would go back and look at the S&P right now. The top 6 names account for 26% of that benchmark, and you'd have to go back to probably to the Nifty 50 to find a level that's this extreme. When I tried to pull up the chart the other day, I don't have enough history to go back to see what that looked like, but in back to, I think, the mid 80s, which I did have, there hasn't been a level or hasn't been a time when we've had this level of concentration in terms of that top 6 names. And then on top of that, you look at the valuations right now, and this chart is showing things in a free cash flow yield. And that is the way we think about valuation. So, when that blue line depicts the free cash flow yield on that top 6. And as you know, right now, it's trading at about, half the level in terms of the free cash flow yield as the broad market. So it's been a significant driver, but that also means it's generating some risk. So I would just sort of note all the above there as it relates to sort of passive investing here. Whether you want to or not, you're making kind of an active decision in the way you're allocating capital just by virtue of the way you select the benchmarks. So.
So Tom, walk us through the process, because you're
Yeah.
active, but institutional cap, by the way, for those who don't know, is a major billion-dollar institutional firm, and your process is very rigorous and systematic.
Yeah.
So walk us through.
Yeah. Yeah. Let me do that. Let me make one more point though, Dan, about the passive versus active conversation, because you could argue that what we're doing is simply building a smarter index. We don't start with the idea that you need to own everything. We start with the idea that equity investors, the equities in general, if you're a long-term investor, tend to generate pretty good returns, and that's just statistically true. And so, when we think about our legacy and what we've done over a long period of time, we think about how investors get in trouble, and we're always sort of thinking about things at a very basic level. So the 2 ways equity investors get in trouble, and I'll relate this to our process in a second, is that if every stock is inherently a stream of future cash flows, any asset is a stream of future cash flows discounted to the present. But if that equity is a future stream of expected cash flows, the way you get in trouble is you either overpay for that expected stream of cash flows, and we address that by thinking about valuation and sort of systematically rebalancing back into those stocks that we think are the least expensive in the marketplace that meet our quality criteria. But that quality criteria piece is a really important part of it. And we are wired, and again, because of Ben Graham and because of Warren Buffett and a lot of other great investors over time who have shed their lessons, and we learn a lot from them, is that we're wired to preserve capital. And so, the second way an equity investors get in trouble is that expected future stream of cash flows fail to materialize. And that's where we sort of probably more differentiate ourselves than a lot of other people, because rather than using surrogates for risk that look at stock price volatility, measures like beta, which is universally taught in business schools, or volatility, we look at each business and the underlying volatility of its legacy of generating free cash flow. And then we also look at balance sheet quality, because, being long-term value oriented guys, we know that very often debt is a contributing factor when things go really quite badly. It's not that we're anti-debt, we just don't want to have too much debt. So when it comes time to building our portfolio, this kind of goes back to your question about indexing. We're simply selecting a portion of the benchmark, a portion of a larger universe to own, and the rules are such that we're doing that systematically. There's no subjective thought being built into this. There's no macro call. There's no timing element to what we're doing. We're letting the numbers dictate where the portfolio goes. So I don't know, Dan, did I sort of start to address
you started to, but you wake up at the quarter end, you're going to rebalance. What do you do? How do you do it? Is really the question.
Yeah, so let me meat on the bones on the process itself. So I'll just start with a large cap US product, and we can talk about the nuances between the three of them. But we're starting with a universe that looks roughly like the S&P 500, 500 largest stocks in the country. We look at each stock each quarter. We go back and see what's going on with their legacy of free cash flow, which obviously doesn't change very much. But ideally, we're looking back through a business cycle to see what that experience has been. And then we're taking into account the forward-looking free cash flow estimates that we get from Wall Street as well. We're also looking at indebtedness. So between those two things, we're eliminating from consideration those stocks that have the most volatile legacies, because we think that's a pretty good indication of the likelihood of future free cash flows being generated. And then to the extent that that hasn't eliminated some highly leveraged situations, we're going to take those off the table as well. Then that forward-looking free cash flow estimate stream, we have to do some work to. The accounting standards, the way they're written, don't always account for everything in a way that we think is entirely fair. So we're doing a bit of adjustment work, but there's no bias to what we're doing. We're applying the same adjustments across all industries. And then we're comparing that free cash flow generation, a normalized number, if you will, that does a little bit of averaging to take out the lumpiness. We're going to compare that to an enterprise value number. And again, we have to do a little bit of accounting work to make sure that everything is correctly represented on balance sheets. But we're going to use effectively that free cash flow yield to rank the valuation opportunities of those names that meet our quality criteria. And then we're going to buy the 100 stocks that are the least expensive in that group. So effectively, we're rebuilding the portfolio every quarter in the context of the way we go about it.
Well, but
the
wait.
last element would be the weighting, Stan, and versus versus a cap weighted scheme, we're actually leaning into the free cash flows. So it's a bit complicated. But what we're doing is we're utilizing the same free cash flows that we use in valuation to lean into those situations that are the most attractive. Pardon me. And to the extent that they get more attractive, we take a bigger bite. To the extent that they become less attractive relative to the others in that group of 100, we take a smaller bite. And we'll take a smaller bite until something else forces a stock out of the portfolio. So again, it's a rules-based portfolio. To your point earlier about it not being just me, it's all three of us that have built this this coding that drives the portfolio. But we flip the switch, and the portfolio is driven by the numbers. It's not a case where subjective judgment is driving our returns.
And those numbers lead you to overweighting and underweighting certain industries. I when I started in this business a long time ago in '87, I was learning under depression babies. And banks were just an area we wouldn't invest in. For a lot of the reasons, well, like we just found out recently, right?
Yeah.
But your process systematically has avoided that, right?
Yeah, because of the leverage factor, largely, Dan. I mean, we don't exclude all financials. So very often you'll see us in names like the CME Group or BlackRock or the payment processors. So you see us with financials in our portfolio, and in fact, right now we're carrying nearly a market weight in financials, where typically we're going to be underweight, because the degree to which the banks are levered really keeps us away from owning the balance sheet, the big balance sheet driven names like JP Morgan or Wells Fargo, or any of the banks. And then to the extent that we look at the legacy of free cash flow generation, there are industries that, just actually have a really lousy track record in terms of generating dependable free cash flow streams. And one of those is energy, which obviously outperformed last year quite strongly, and was a headwind for us. But, and in fact, they're generating good free cash flow right now, and have shown some discipline in terms of not just taking that free cash flow and drilling more holes in the ground, but and over time, if that discipline continues, they're as eligible to be in our portfolio as any other sector. But if you look back through time, that would be the other place that we haven't seen a lot of exposure.
Okay, so we've talked a lot about DSTL.
Yeah.
And that's great, but you also have two other strategies, one that's small mid cap and another one that is international. How have you found your process applying to those other types of strategies?
When we developed the process, which I sort of hinted at, we actually started working on that a long time ago, about 10 years ago. And we had the data, and we were known for being a US value shop. And so that's, of course, where we started. But then once we had it built out, we said, okay, if the logic works here, it should work equally well outside the US. It should work up and down the cap spectrum. Tell me where it doesn't work. And when we went back and sort of ran a simulation to see how it would have worked over time, we really couldn't find another starting universe where it didn't work, including emerging markets, which we don't have that capability at the moment. But again, there just wasn't a place where we didn't find connectivity. Internationally, what we're doing is essentially identical to the US. There are a few incremental guardrails that we don't make use of in the US, and they're done for the purpose of preserving capital. So when you look at the starting universe in the international case, we start with the All Country World Index ex-US. And there's simply a lot of stuff in there that you probably would not want to own. So we actually hold the threshold for stability, sort of that look back through each company's performance. We hold that threshold a little higher outside the US than we do domestically. We won't invest in a handful of countries, including Russia. And then there's a minimum market cap need, and there's a minimum liquidity need. And then there's a geographic control as well that's just assures us that we always have a geographically diversified portfolio. But other than that, it runs with exactly the same thought process in terms of going through a quality screening first, and then buying what is least expensive. And then with the exception of those, handful of constraints, the portfolio goes where it goes. On the small cap side, for a second, just in terms of portfolio construction, the data availability there is just not what it is in the large cap space. So we're utilizing trailing free cash flows when we think about valuation in small caps, and we can't use that stability factor. So we're solely looking at balance sheet quality rather than looking at stability. We can run the number after the fact and report on it, but it's not an element of portfolio construction. It's a really interesting starting universe there as well. It's at the moment in our work does not look inexpensive. On a PE basis, people are making the case that small caps are opportunistic, but very often they do that by excluding the companies that are not expected to generate earnings when they calculate a PE. When you look at the free cash flow yields, they're lower. And on top of that, there's a lot of leverage. The leverage that was caused by low rates is evident in that segment of the market, and a lot of it needs to be rolled in the next couple of years. Obviously into higher rates. And then on top of that, there's a fairly meaningful portion of that benchmark that is not expected to generate any excess free cash flow right now, nearly 20% of the Russell 2000 and 2000 value. And as a point of comparison, I think the number for the S&P 500 is 3%. So the starting benchmark there is again one that we think demands that you be selective, and by being selective, when we own 150 stocks in that portfolio as opposed to 100 in both the large cap US and the international product, we're generating a free cash flow yield, an expected free cash flow yield that's meaningfully better, significantly better than the underlying benchmark, without the leverage and without any of those negative free cash flow generating businesses. So it's an interesting place.
So you use the word stability. I mean, is that kind of like, well, smart beta, dumb beta? Talk to us a little bit about what stability means, because I'm not sure everybody knows.
No, it's sort of unique to the way we do things. When we talk about stability, we're actually looking at each business over time and developing a metric that allows us to quantitatively compare how stable their free cash flow generation is. So if you look at Alphabet, sort of an extreme example, but if you chart their free cash flow, it's this, beautiful upward sloping line over, 15, 20 years that you can't even spot a recession. You can't even spot a global recession. You can't, you don't see the great financial crisis. You don't see anything because it just grows through that with remarkable stability. Whereas, some businesses, and very often when we look at a side-by-side comparison, we're looking at a public utility, which a lot of people would sort of assume would be a reasonably consistent provider of free cash flows. But in fact, it's not the case. They tend to be cyclical. They tend to, have these large expenditures that make their histories look anything but stable. And then on top of that, those businesses tend to carry a lot of leverage. And as we all well know, some of these big, tech names that look expensive to us at the moment also have these sort of rock solid balance sheets. So when you look at risk, very typically, people are taught to think about it in the context of beta. Unfortunately, if you do that side-by-side comparison between Alphabet and a public utility, what you see is that the volatility of Alphabet suggests it's a riskier stock. And in the context of your need for liquidity, you don't certainly want to suggest that somebody completely ignore that. But in the context of making the correct stock decisions, the correct stock selection decisions, beta very often, or volatility very often, stock price volatility very often are going to push you to do the wrong thing at the wrong time. Microsoft's volatility went off the charts, during the downturn in 08 and 09. the stock went from being 15 times cash flow to 5 times cash flow. It just extraordinarily cheap for a global franchise like that. And yet, people that were utilizing vol or beta were pushed away from taking that risk when it was the most opportune time to do that. So we've essentially just sort of reordered the risk thought process in the context of the way we do stock selection.
Now, we've been mostly talking about DSTL, right? Do you find that in the other two ETFs, DSMC and DSTX, also underweight financials and energy?
Financials, yes, both. You'd see that's the case in both of those portfolios for the same reason. It's leverage. And just in the interest of full disclosure, it was a big headwind for DSTX until this year. So the last couple of years, we were behind the benchmark. We had a sort of a massively good year the year before we launched the ETF, and then we launched right into rates drafting higher, which obviously were a great tailwind for that segment of that benchmark, and it's a bigger segment of that benchmark. But now we're seeing that, kind of come back our way this year. Energy companies outside the U.S. are a little different than they are inside the U.S. They're a bit more like tolling companies, and their consistency of generating free cash flow is better than it has been in the U.S. So it hasn't been the chronic underweight. And then interestingly, by virtue of not having the stability scores be a factor in the context of the small mid-cap portfolio construction, we end up having a little bit of an overweight in energy in that portfolio right now. That goes to that point. If these companies are disciplined, it does look like they're very inexpensive at the moment.
Interesting. And not everybody's definition is the same for international, meaning from a geography standpoint.
Yeah.
What's your makeup by country?
It's very dynamic, Dan. What we, the All Country World Index ex-US includes the emerging markets, and we oftentimes think about the businesses that we own, not really being that tied to where they're domiciled. So we're kind of indifferent. That said, we're a little bit cautious about not getting overexposed to any one currency. So we break the world up into 5 different regions. So we're looking at Asia. We're looking at Japan as opposed to the rest of Asia. We're looking at Europe. And when we do that exercise, we're going to limit the portfolio to being no more than 150% of the underlying benchmark weight, just to be sure that we're always having a geographically diversified portfolio. And at the moment, the standout in terms of overweighting is Japan. So it's about 20% of our portfolio. It's about a 14% benchmark weight. It's about, as far as it's going to go in terms of the overweight. And after that, when you look across the portfolio and the country weights, there's really nothing that's remarkable or outstanding or anything that you'd make note of.
Well, but getting, I think, Japan right as an example has a huge impact. I mean,
yeah, and those companies are generating free cash flow. It seems to be an interesting turn of events. We're not the only one that has noted that, but the opportunity relative to the rest of the constituents is still really quite good there.
It's interesting. I think way too often people forget that ETFs are a source of information. You just highlighted something, and I wasn't aware of, which is, that it's Japan's rally is off of fundamentals. It's not just that the central bank was buying up all the stocks, right?
Yeah.
And we finally moved forward, right? So it's an interesting point about Japan having great cash flow and free cash flow, to your point. And I would expect most of the companies in Japan not to be leveraged, just given their culture.
Yeah, no, an inherently risk adverse culture. I think that's largely true, Dan.
Yeah, yeah. So along those same lines, when you're talking to financial advisors, we've been on a number of calls where you've offered up, ways that you can help financial advisors. Talk to us a little bit about some of that research offering that you've had and what experience has occurred.
Yeah, so I mean, we try to be as interactive with our clients as we can be. I mean, we really want a set of clients that understand what we do and what to expect, because inevitably there will be market environments, and this year is one where the S&P is running very hard, with a very narrow set of leadership that didn't look very cheap to us to begin with, and yet the valuations get a little more stretched, and so we're facing a bit of a headwind. And I'm really happy to report that we're when we go to clients and talk about that, there's just no angst, because I think we've done a reasonably good job of telling people what we do, and to inform them of what to expect. We do, when we launched the firm, we wrote a series of white papers. Those are all on our website under the Insights page. We've gotten a lot of good feedback on them, because the story that we ran through earlier about the change in our economy and why you need to think about valuation differently. We're not making the argument that you need to pay more for certain sorts of businesses, right? We're not making the case that you need to isolate a grower and pay more for it. We're simply saying you need to think about value correctly, and if you do, the value style still works. I think those papers have been pretty enlightening to people, in the context of helping people understand why the value strategies that they perhaps have had their clients in have not performed the way they would have expected. One of the exercises we went through was to simply look at the growth and the value benchmarks back over the course of the last decade. And when you use free cash flow as a better metric to gauge the underlying economic performance of the businesses that you might own, you can gross that up to the index level. When you look at that work, and you look at the free cash flow yield of the growth benchmark and the value benchmark, what you will see over time is that, for much of the last decade or more, the value benchmark was actually more expensive than the growth benchmark. The free cash flow generation there was such that the value benchmark was hardly a value, which, if you twist your head around far enough, it sort of reaffirms the thought that value kind of as a strategy, if measured correctly, still works, right? Because the cheaper index outperformed. Now, those things, crossed over here in the last couple of years, and we've not shockingly seen the value benchmark do a little better at times. The other one is on international, which is sort of the same exercise. You can go back and look at international versus the U.S. on the basis of free cash flows, and when you do that, although optically a decade ago international stocks looked cheaper on a PE basis, when you looked at the free cash flow numbers, they were actually more expensive. And not only were they more expensive, but they're more levered. They tend to be less stable. It's just a group of businesses that have more inherent volatility. There's more basic materials, there's more energy, there's more banks. And the growth profile wasn't all that good. So if some people puzzle over why the U.S. has done so well, and you get questions about U.S. exceptionalism, it could be just that the answer is that the market reacted correctly to where the value opportunity was. Now, interestingly, I'd stop and say at this point, the international benchmark is actually less expensive than the U.S. benchmark as a starting point. The portfolio that we're building with 100 stocks is actually got free cash flow yield that's probably 100 basis points better than the domestic portfolio. So we like the opportunity in the international side, and we're seeing more interest in it. But again, by virtue of utilizing free cash flows, I think you find yourself answering questions that people have had for a while related to how the market works.
Yeah, so there's a lot of debate now and nobody knows the answer, but whether inflation is under control here in the US. Maybe
Yeah.
there's less debate about that internationally. Um, when you think about free cash flow, um, what are the implications to inflation in that context? If inflation is under control, is that better for the free cash flow companies? I know from my experience as a portfolio manager, if we're going in a recession, that's not so good for small cap companies. Um,
Yeah. Yeah. So there's certainly some logic to the idea that if inflation is under control and therefore, we'll see those numbers tamp down, and you could potentially see rates come down, that the risk, that you see in small caps related to the amount of leverage that's there, the amount of debt that needs to be rolled over, the incremental costs that those companies could incur, would provide something of a tailwind for that group. But I would tell you, Dan, that we think a lot of times the market anticipates those things. The question is, where is still the relative value versus the opportunity set and the cash flows that we have to work with. So I think I said it a couple of times already, but we're not trying to make a macro call on something like that. The free cash flow streams that we're thinking about, just to be clear, when we say free cash flow, we mean, truly all the uses of cash have been accounted for. So, it's after capital spending, it's after investment spending, it's after, R&D and advertising and everything else. It's sort of everything that the business is put into itself to continue to grow. And if there's a meaningful amount of free cash flow available, we're not trying to make a presumption about how that cash flow gets used, right? It could be used to retire debt, it could buy back shares, pay dividends, do acquisitions, but it's powerful in the context of being defensive. Certainly, it provides downside protection. When you look at the great, if you look at the downturn during the pandemic, I think something like 80% of the decline in free cash flow estimates in the S&P were accounted for by 60 businesses. Businesses can react, and so free cash flow is a much better long-term metric to think about when you're thinking about the valuation opportunities, because there just isn't the volatility in it that you see in earnings. But the other thing is, companies that have free cash flow and are willing to buy back shares, you can see that oftentimes is also an incremental driver to earnings per share, or to the improved value that comes with being able to repurchase shares. You go back to when Apple was buying shares back at 10 times cash flow. I mean, that's an extraordinarily creative transaction for existing shareholders, right? And now that stock is re-rated in a meaningful way, that sort of opportunity doesn't exist at the moment. But yeah, we're sort of the belief that free cash flows are, just in an evergreen sense, a better way to gauge the underlying economic performance of the businesses, and that there's certain advantages to being in those businesses, and certainly capital preservation is sort of potentially first on the list.
Yeah, for me, regardless of whether it's large cap, small cap, mid cap, or international, if the multiple compresses, right, that doesn't necessarily mean that the value's not there, right? It just means that it's a greater opportunity,
Yeah.
especially to your point, if there's quality, there's durability, there's stability of those cash flows, and there's limited leverage.
Yeah.
So
Yeah.
I totally get that. Listen, we're coming up to the top of the hour here. We thank everybody for being on the tank call here. So Tom, you're coming up on your 5th year anniversary. What are you guys going to do to celebrate? Going to do a bell ringing? I hope to be invited, just for the record.
Yeah, we haven't done that yet. Go down and do a bell ring. Yeah, we could do that. We don't have any plans, Dan. I mean, we'll have to work something out. we just built this thing, kind of one investor at a time. I mean, you and others have given us a lot of kudos for building, a meaningful asset base at this point. It's $1.1 billion, and just we come from an environment where we were managing a lot more, so we don't look at it probably with as much kind of the same way that you might, but yeah, we're really excited about the business. I mean, we like we like the opportunity set, we like the differentiation that we provide. We're excited about the small mid cap ETF, which was just launched last October. The numbers there are really good. International is back in the black in terms of its since inception track record, and there is nothing about that portfolio that we want to change in terms of the way it's engineered to work. We believe in the long-term opportunity there, and we think we can help people, which is a lot of fun, honestly. And like I said, we enjoy talking to the RIA community. So, if we have a bunch of RIA calls or a bunch of investor calls that you arrange for us on our 5th anniversary, that would not be the worst thing to do.
Absolutely. Thank you for being a supporter of the ETF think tank. We really do look forward to continue to work with you, and thank you everybody else for being on these calls.
Yeah, thanks, Dan. It was good fun.
Absolutely. Have a good one.
Take care.
Bye-bye.